Somewhere out there tonight, two people are opening their first investment account at the exact same time. Same age, same salary, same $400 a month left over after rent. One of them spends the next 6 months researching the perfect stock, watching crash predictions on YouTube, waiting for the right moment to get in. The other one buys the most boring fund in existence, sets up an automatic transfer, and forgets the app is on his phone. 30 years from now, the boring one retires with over $1 million. The smart one, the one who did all the homework, read all the news, timed all the dips, ends up with less than half of that. Same money, same market, same 30 years. And it's not because one of them picked better investments, it's because one of them barely participated in his own portfolio. This isn't really a video about investing. It's a video about getting out of your own way in the single strangest market in modern history. Let me show you exactly what I would do. My name is Nick, and I spend way too much time thinking about money and why perfectly intelligent people keep lighting theirs on fire. If you've ever stared at an investing app for 20 minutes and then closed it because you had no idea what button to press, make sure to subscribe and hit that like button, because by the end of this video, you'll know exactly what to do with your money in 2026, in what order and why. This is the full guide. Grab a coffee. Now, before we touch a single dollar, I need to be honest with you about the year you've chosen to start investing in. Because 2026 is not a normal year, and anyone making a beginner's guide who doesn't tell you this up front is doing you a disservice. Here's the situation. The American stock market just had 3 incredible years in a row. The S&P 500, that's the index of the 500 biggest US companies, and don't worry, we'll break all of this down properly in a minute, returned about 25% in 2024, almost 18% in 2025, and as I'm recording this in mid-2026, it's up roughly another 11% this year. If you'd been invested this whole time, you'd be feeling like a genius right now. But here's where it gets interesting. And by interesting, I mean slightly terrifying. Because of those huge gains, American stocks are now trading at the second most expensive valuation in 140 years of recorded market history. There's a measurement called the Shiller-Cape ratio. Basically, it compares stock prices to the actual profits those companies earn, averaged over a decade. The long-term average of that number is around 17. Right now, it's sitting at about 40.7. The only time it's ever been higher was December 1999. And if you know anything about what happened to the stock market right after December 1999, you understand why some very smart people are nervous. On top of that, the market has never been this top-heavy. 7 companies, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, the so-called Magnificent Seven, now make up almost 35% of the entire S&P 500. 7 companies out of 500 are more than a third of the whole index. So when you buy the market in 2026, you're really buying a massive bet on big tech and artificial intelligence with 493 other companies along for the ride. And the people whose entire job is forecasting this stuff, they're not exactly thrilled either. Vanguard, one of the largest investment companies on earth and about the least dramatic institution in finance, is currently projecting that US stocks will return somewhere between 3.5% and 5.5% per year over the next decade. Not the 10% historical average, 3.5 to 5.5. Because when you buy something expensive, your future returns tend to be lower. That's not pessimism, that's just arithmetic. So at this point, you're probably thinking, cool, Nick, great pep talk. Sounds like I should wait for the crash. And if that's what you're thinking, I hate to be the bearer of bad news, but that instinct, that completely reasonable, completely human instinct, is the single most expensive mistake in all of investing. Let me show you why. Back in 2012, financial media was full of articles arguing the market was overvalued. Some said by as much as 50%. The S&P 500 was trading around 1,400 points. People waited for the crash. The crash never came. The market is now more than 4 times higher than it was then. The people who waited for the obvious correction didn't protect themselves from anything. They just missed 13 years of gains while standing safely on the sidelines, being right about valuations and poor about everything else. And here's the statistic that should permanently end the timing debate in your head. Over every single 20-year period in American stock market history, everyone, including the periods containing the Great Depression, the 1970s stagflation, the dot-com crash, 2008, and COVID, the S&P 500 has never lost money in real inflation-adjusted terms when you include dividends, not once. The market punishes impatience and rewards stubbornness, and it has been doing this consistently for a century. So, no, expensive markets don't mean you wait. They mean you stop gambling. They mean the boring, diversified, low-cost plan I'm about to walk you through goes from good idea to the only idea that makes sense. Everything in this video is built for exactly the market we're standing in. But before we get to the how, we need 30 seconds on the why. Because if you don't understand why you're doing this, you'll quit the first time the market drops 20%. And spoiler alert, it will. Let me paint you a picture of what your money is doing right now if it's sitting in a regular checking account. It's dying, slowly, politely, and with a smile. Inflation in early 2026 spiked back up to 3.8%, the highest it's been since 2023, thanks in part to an oil shock nobody asked for. Meanwhile, the average traditional savings account in America pays 0.38% interest. So your bank is paying you basically nothing, while everything you actually buy gets almost 4% more expensive every year. That's not saving. That's paying a storage fee for the privilege of getting poor. Run the real numbers. If you have $10,000 sitting in a normal account and inflation runs even at a modest 3% for 10 years, that money will still say $10,000 on your screen, but it'll only buy about $7,400 worth of stuff. You lost $2,600 and there was no crash, no scam, no bad decision. You just stood still. Standing still is the bad decision. Now compare that to what invested money does. The US stock market has historically returned somewhere around 10% per year on average over the long run, like about 7% after inflation. And the magic isn't in any single year. The magic is what happens when those returns stack on top of each other. That's compounding. And I need you to actually feel this concept, not just nod at it. Say you invest $1,000 and it grows 10% this year. You now have $1,100. Fine, $100. Dinner for two if nobody orders an appetizer. But next year, you don't earn 10% on $1,000, you earn it on $1,100, then on $1,210, then $1,331. The growth itself starts growing. Leave that single $1,000 alone for 30 years at 10%, and it becomes roughly $17,400. You did nothing. The money did everything. Now, here's the part nobody tells beginners, and it's the reason most people quit. Compounding feels like a scam for the first decade. Charlie Munger, Warren Buffett's late business partner, famously said the first $100,000 is the hardest, and the math backs him up completely. If you invest $500 a month at 7%, it takes you about 11 years to hit your first $100,000. 11 years. But the next $100,000 takes around 6. The one after that, 4. Eventually, you're adding $100,000 faster than you used to add $10,000 because by then, your portfolio is generating more money per year than your contributions are. Early on, you are doing all the work and the money is freeloading. Later, the money does all the work and you're the freeloader. Every wealthy retiree you've ever met simply survived the freeloading phase. Okay. So we know cash is a slow leak and compounding is the engine, which brings us to the most uncomfortable section of this entire video. Because before I tell you what to buy, I have to tell you about the only thing that can actually wreck this plan, and it's you. Every year, a research firm called Dalbar runs the same depressing study. They measure two numbers, what the stock market returned and what the average investor in the stock market actually earned. You'd think those numbers would be identical. The market goes up 25%, investors earn 25%. Same boat, same ocean. They are not identical, they are not close. In 2024, the S&P 500 returned just over 25%. The average equity fund investor earned 16.5%. That's an 8.5 percentage point gap. Money that evaporated not because of fees, not because of fraud, but because of behavior. People bought after things went up, sold after things went down, sat in cash waiting for clarity, jumped back in late, and repeated this cycle like it was a fitness routine. The market handed everyone 25%, and the average person fumbled a third of it onto the floor. How? Mostly by doing what feels right, and in investing, what feels right is almost always wrong, because the entire game is rigged against your instincts in one specific brutal way. Here it is. JP Morgan studied what happens if you invested $10,000 in the S&P 500 and just left it alone for 20 years. Fully invested, never touched, you'd earn about 10.6% per year. But if you missed just the 10 best single days in that entire 20-year stretch, 10 days out of roughly 5,000 trading days, your return collapses to 6.4%. Miss the 30 best days, and you're down to 1.5%, which is to say you'd have been better off in a savings account. In one version of this study covering 2003 to 2022, the buy and hold investor turned $10,000 into about $64,800. The investor who missed the 10 best days ended with $29,700, less than half the money, for missing 10 days. Fine, you're thinking, I just won't miss those days. You will. And here's the cruel, almost comedic reason why. 7 of the 10 best market days in that study happen within 15 days of the 10 worst market days. The best days and the worst days are next door neighbors. They show up at the same parties. So the moment you panic sell after a horrible week, the moment that feels most responsible, most prudent, most adult, is statistically the exact moment you're about to miss one of the explosive rebound days that your entire 20-year return depends on. The market collects its biggest tolls from people fleeing the building. There's a legendary story in finance, and I'll be honest with you, it's probably apocryphal. Fidelity has never actually confirmed it, that an internal study once found the best performing customer accounts belonged to people who were either dead or had forgotten the account existed. Now, even if that study never happened, the fact that every financial professional repeats it tells you something true. Inactivity outperforms activity. The less you touch it, the better it does. Your portfolio is the one area of life where neglect is a superpower. And if you need the other end of that spectrum, a study in Brazil tracked everyone who attempted day trading over multiple years. Of the people who stuck with it for more than 300 days, the committed ones, the ones who really tried, 97% lost money, only 1.1% earned more than minimum wage. A separate study in Taiwan found fewer than 1% of day traders were persistently profitable after fees. These aren't lazy people. They're often smart, motivated people working very hard to convert their savings into other people's savings. So here's the deal we're making for the rest of this video. Every strategy I give you is designed around one assumption: that you are a human being with human emotions who will absolutely panic at some point. We're not building a portfolio for the genius version of you. We're building one, the panicked 2 a.m. version of you can't easily destroy. Step 1 of that plan weirdly has nothing to do with the stock market at all. If I were starting from zero in 2026 before I bought a single share of anything, I would do 2 unglamorous things. And I know you want to skip this part. Everyone wants to skip this part. The people who skip this part are the ones selling their investments at a 30% loss 2 years from now because their transmission died. So stay with me. First, high interest debt. If you're carrying a credit card balance, I have genuinely incredible news for you, which is a weird thing to say to someone in debt. The average credit card in America right now charges between 21 and 24% interest. Americans are collectively sitting on about $1.25 trillion of this stuff. And here's the reframe that changes everything. Paying off a 22% credit card is mathematically identical to finding an investment that pays you a guaranteed, tax-free, zero risk 22% return. Let me put that in perspective. Warren Buffett, the most successful investor in human history, averaged about 20% a year over his career. Vanguard thinks the stock market might do 5% for the next decade, and you, sitting there with a Visa balance, have access to a guaranteed 22%. There is no fund, no stock, no crypto coin, no real estate deal that reliably beats paying off your credit card. None. So every dollar of high interest debt gets destroyed before serious investing begins. The general cutoff I'd use, anything above about 7% interest, kill the debt first. Below 5%, like some older car loans or student loans, you can reasonably invest alongside it. Between 5 and 7, honestly, that's a coin flip. Do whichever one helps you sleep. Second, the emergency fund, 3 to 6 months of essential expenses sitting in a high-yield savings account, not a regular savings account paying 0.38%, a high-yield one which in 2026 pays around 3.5%, because the Fed is still holding rates at 3.5 to 3.75%. Same FDIC insurance as your regular bank, roughly 12 times the interest, takes 10 minutes to open online. The fact that most Americans haven't done this is one of the great mysteries of modern finance, right up there with why anyone leases a luxury car. Now, why does an investing video care this much about a savings account? Because the emergency fund isn't really a savings product, it's armor for your portfolio. Here's the thing about market crashes, they have impeccable comedic timing. They love arriving in the same season as your layoff, your medical bill, your busted water heater, and if your investments are your emergency fund, you'll be forced to sell at the exact bottom, converting a temporary paper loss into a permanent real one, and missing those neighbor of the worst days, rebound days we just talked about. The emergency fund is what lets you look at a crashing market and feel nothing. It buys you the most valuable asset in investing, which is the ability to do absolutely nothing. One practical note, you don't need the full 6 months saved before you start investing. That could take years, and we just established that time in the market is everything. Get 1 month saved as a starter buffer, kill the toxic debt, grab your 401k match, which I'm about to explain, and then build the rest of the emergency fund in parallel. Speaking of that match, we've arrived at the part of the video where I get to tell you about the only free money that exists in the entire financial system, and about the 25% of people who walk past it every single day. Okay, so here's something that confuses every beginner, and it's not your fault, because the industry names things like it's actively trying to lose you. An account is not an investment. A 401k is not a thing you buy, it's a container, a bucket with specific tax rules, and the investments go inside the bucket. Same investment, different bucket, wildly different outcome, because the buckets decide how much the government takes. So before we pick investments, we pick buckets in order. Bucket number 1, the 401k, but only up to the employer match. This is the account you get through your job, where money comes out of your paycheck before you ever see it. And most employers offer a match. Commonly something like, we'll put in 50 cents for every dollar you contribute up to 6% of your salary, or dollar for dollar on the first 3%. I need you to understand what that actually is. If your employer matches 50% of your contributions, that is an instant, guaranteed 50% return on your money the day your contribution lands, before the market does anything. There is nothing else like this anywhere in finance. Buffett would weep, and yet about 1 in 4 workers doesn't contribute enough to get their full match. Collectively, Americans leave roughly $24 billion of this free money on the table every single year. The average person who undercontributes forfeits around $1,336 annually, which compounded over 20 years is about $43,000. $43,000 declined mostly because the enrollment form was confusing. The system isn't even hiding this money from you. It's sitting in the open with a sign on it, and HR sent you 3 emails about it that you archived. So that's non-negotiable step 1. Log into your 401k portal this week and make sure you're contributing at least enough to capture the full match. In 2026, you're allowed to put up to $24,500 of your own money into a 401k. But for now, just hit the match. Bucket number 2, and this is the one almost nobody knows about, the HSA, the Health Savings Account. If your health insurance is a high deductible plan, and a huge chunk of plans are these days, you qualify for what is quietly the most tax-advantaged account in America. In 2026, you can put in up to $4,400 as an individual or $8,750 for a family. And that money is triple tax advantaged. The money goes in untaxed, it grows untaxed, and it comes out untaxed for medical expenses. Every other account in existence makes you pay tax at the entrance or the exit. The HSA somehow has no doors. Here's the power move most people miss. An HSA isn't a spending account, it's a stealth retirement account. Most providers let you invest the balance in index funds. So you invest it, pay today's small medical bills out of pocket, save the receipts, and let the account compound for decades. After age 65, you can withdraw it for anything. At that point, it just behaves like a regular retirement account, except you also have a folder of 30 years of receipts you can reimburse yourself for, tax-free whenever you feel like it. It's the only account where the IRS just loses on every front. Use it. Bucket number 3, the Roth IRA. This one you open yourself online at any major brokerage. Takes about as long as ordering a pizza. In 2026, you can contribute up to $7,500 a year as long as you earn under $153,000 as a single filer, where the phase-out starts. The Roth deal is simple. You pay tax on the money now, it grows for decades, and then every penny, like including all the growth, comes out completely tax-free in retirement. Think about what that means for a 25-year-old. You contribute $7,500 of already taxed money today. 40 years later, it might be worth $110,000 plus. The government's cut of that growth, zero. You paid tax on the seed and got the entire tree for free. This is also why the Roth is the single best account for young people specifically. You're probably in the lowest tax bracket of your life right now. Paying taxes today at your career's cheapest rates in exchange for never paying taxes again on decades of compounding is one of the most lopsided trades available to a normal person. As a bonus, your direct contributions, not the growth, just what you put in, can be withdrawn anytime without penalty, which makes the Roth a surprisingly forgiving account for someone nervous about locking money away. Quick side note, because you'll hear these terms, traditional accounts are the reverse deal. Tax break now, pay taxes later in retirement. Rough rule of thumb, lower income or early career, go Roth. High income and peak earning years, traditional starts winning. If you're under 30 and not earning six figures, Roth, and move on with your life. Bucket 4, back to the 401k beyond the match, working toward that $24,500 cap if your income allows. And bucket 5, once everything above is maxed, the regular taxable brokerage account. No special tax breaks, but also no limits and no rules. Your money is never locked up. And even here, the tax code is gentler than people think. Hold an investment more than a year, and the long-term capital gains rate applies, which in 2026 is literally 0% if your taxable income is under $49,450 as a single filer, and 15% for most people above that. So here's the full order of operations. The part of this video worth screenshotting. 1. 401k up to the match, because nothing beats free money. 2. Destroy debt above 7% interest, because nothing else guarantees you 22%. 3. Finish the emergency fund 3 to 6 months. 4. Max the HSA if you're eligible. 5. Max the Roth IRA. 6. Keep filling the 401k. 7. Taxable brokerage for everything beyond. That order alone puts you ahead of the vast majority of American investors, and we haven't picked a single investment yet. Which, fine, fair. The buckets are built. Let's talk about what actually goes in them, and why the answer is going to feel almost insultingly simple after everything Wall Street has spent a century telling you. Let's start with what I would not do, which is Pick individual stocks, and I want to give you the real reason, not the vague, it's risky hand wave, but the actual math, because once you see this number, you can't unsee it. A finance professor named Hendrik Bessembinder did something nobody had bothered to do. He analyzed every single US stock since 1926, every company, the entire history of the modern market, and what he found should be printed on the door of every brokerage app. 4 out of every 7 stocks, the majority, returned less over their lifetime than 1-month treasury bills, less than the most boring, risk-free government IOUs in existence. The majority of stocks ever were not worth buying. So where did all the market's legendary wealth come from? From a freakishly tiny minority. Just 86 companies out of tens of thousands produced half of all the wealth the stock market has ever created. The top 4% of companies account for all of it. The other 96% combined collectively matched treasury bills. Let that reframe what stock picking actually is. It's not choosing good companies like it's trying to find the 4% of needles in a haystack where most of the hay is secretly losing to a savings bond. Miss the needles, and statistically you will. And your diversified portfolio of 10 hand-picked stocks quietly underperforms doing nothing. Okay, so you're thinking, I'll pay a professional, a fund manager, someone with a Bloomberg terminal and a Patagonia vest whose entire job is finding the needles. Here's where it gets really interesting, and by interesting, I mean career-endingly embarrassing for an entire industry. S&P runs a scorecard called SPIVA that tracks professional fund managers against a simple, brainless index. In 2025, one of the 4 worst years for active managers in the scorecard's history, 79% of professional US large-cap fund managers underperformed the S&P 500. Over any 15-year period, more than 90% of them lose to the index. Over 20 years, about 92%. And the few who do win, the persistence data shows the winners almost never repeat. Top performing funds stay on top at rates worse than a coin flip, which is the polite academic way of saying it was luck. So the people with the terminals and the research teams and the 8-figure bonuses lose to a list. Not a clever list. An alphabetical by market cap list. Which brings us to the hero of this entire video, the index fund. Instead of finding the needle, you buy the entire haystack. One share of a total market index fund makes you a part owner of every major company in America. Every Apple, every Nvidia, but also every needle that hasn't been discovered yet. You can't miss the 4%, because by definition, you always own them. You will never beat the market, and you will never lose to it. You'll simply get the market's return, which, per everything above, beats roughly 9 out of 10 professionals over your investing lifetime. Mediocrity, it turns out, is elite, and the price of admission is the punchline. Let me name actual names because beginners deserve tickers, not vibes. VTI, Vanguard's total US stock market fund, costs 0.03% a year. VOO, just the S&P 500, also 0.03%. Fidelity's S&P 500 fund, FXAIX, 0.015%. Fidelity even has FZROX, a total market fund that costs exactly 0.00%. They run it for free as a loss leader. Meanwhile, the average actively managed fund charges somewhere near 1%, and plenty charge more. Nick, who cares? 1% is nothing. Let me show you some math that might genuinely upset you. Take $100,000 growing at 7% for 30 years. At a 0.03% fee, you end with about $761,000. At a 1% fee, same money, same market, same 30 years, you end with about $574,000. That one little percent quietly consumed $187,000, a quarter of your wealth, gone, not to a crash, not to a mistake, but to a line item you never looked at. Fees are the only thing in investing that compound against you with absolute certainty, which is exactly why the industry prints them in font size 6. Now, one more option, and it's the one I genuinely recommend to anyone who wants to think about this for 0 additional minutes. The target date index fund. You buy one single fund with your retirement year in the name, target retirement 2065, say, and it does literally everything. It holds US stocks, international stocks, and bonds, automatically rebalances, and automatically gets more conservative as you age. It is the entire rest of this video in one purchase for about 0.08% a year at Vanguard or Schwab. One trap, though, because of course there's a trap. At Fidelity, the Freedom Index target date funds cost 0.12%, but the nearly identically named Freedom funds, no index, are actively managed and charge up to 0.65%. Same company, same name, 5 times the price, and the only difference is one missing word. That is not an accident. Read the label, all right? You know the buckets, you know the weapon of choice. Now let's assemble the actual portfolio. And this is where 2026 specifically changes the answer in a way it wouldn't have 5 years ago. Remember the setup from the beginning. US stocks at their second highest valuation in 140 years, 7 companies making up a third of the index. That doesn't change whether we invest. It absolutely changes the recipe. The classic recipe is called the 3-fund portfolio, and it's beloved by the most militantly frugal community on the internet. The Bogleheads, named after Jack Bogle, the guy who invented the index fund and then refused to get rich off it. 3 ingredients: a US total market fund like VTI, an international total market fund like VXUS, which costs 0.05% and owns thousands of companies across Europe, Asia, and everywhere else, and a total bond fund like BND. That's it. 3 tickers, the entire investable planet, total cost of about 0.04%. Let's talk about that international piece, because for the past 15 years, it was the portfolio ingredient everyone made fun of. US stocks demolished international stocks for a decade and a half, and why do I even own this was a fair question. Well, in 2025, for the first time in nearly 15 years, international stocks beat the US, and it wasn't close. Over the trailing year, VXUS returned around 31%, roughly double the S&P 500. And looking forward, remember, Vanguard's projections, 3.5 to 5.5% per year for US stocks over the next decade, but 4.9 to 6.9% for international, precisely because the rest of the world isn't priced like December 1999. Now, I'm not telling you to dump everything into international, or that would be the exact performance-chasing behavior this video exists to prevent. Warren Buffett himself famously wants his own estate in 90% S&P 500. So, reasonable people genuinely disagree here, but holding something like 30 to 40% of your stocks internationally means you're no longer making one concentrated bet that 7 American tech companies stay perfect forever. In a market, this top-heavy diversification isn't a personality trait. It's the seatbelts. Then there's bonds, which are basically loans to governments and corporations that pay you steady interest. For your entire adult life, bonds were a punchline because they yielded basically nothing. That era is over. With rates where they are in 2026, bonds actually pay real money again, which means the boring stabilizer in your portfolio finally earns its keep. How much you hold is about your stomach, not your IQ. In your 20s or 30s with decades ahead, anywhere from 0 to 20% bonds is reasonable. 90 to 10 stocks to bonds is a perfectly good default. The honest test. If a 30% crash would make you sell everything, you need more bonds than a spreadsheet says, because the best portfolio isn't the one with the highest theoretical return. It's the one you'll actually hold through a bloodbath. So, a dead simple 2026 starter portfolio for someone young. Roughly 60% US total market, 30% international, 10% bonds. Or, and I cannot stress this enough, just buy the target date fund, which is that portfolio with a self-driving feature. There is no shame in the one fund solution. The shame is in the guy with 14 ETFs who can't explain why he owns any of them. Let's make this real, because open a brokerage account stops people for months, and it should stop you for about one lunch break. Where? Fidelity, Schwab, or Vanguard. Any of the three. They all offer zero commission trades, no account minimums, and fractional shares. Meaning if a fund trades at $600 a share, you can buy $50 worth. The differences between them are roughly the differences between 3 brands of bottled water. Fidelity's app is probably the smoothest for beginners. Vanguard invented the whole philosophy, but their app feels like it was designed during the Clinton administration. Pick one, open a Roth IRA, connect your bank, done. Now, 2 execution questions every beginner agonizes over, and the data has answered both. Question 1, I have a lump of cash. Should I invest it all at once or spread it out? Vanguard studied this across decades of market history. Investing it all immediately beats slowly averaging in about 68% of the time, simply because the market goes up more often than it goes down, and money on the sidelines misses that. So the math says lump sum. But, and this is me being honest rather than optimal, if dumping your entire savings in on a Tuesday and watching it drop 8% by Friday would break your brain and make you swear off investing, then spread it over a few months. A slightly suboptimal plan you stick with beats a perfect plan you abandon. The math is only undefeated on paper, you have to live in your head. Question 2, when do I buy? Wrong question. The answer is automatically every payday forever. Set up an automatic transfer and automatic investment the day after each paycheck lands, and you've just institutionalized dollar cost averaging. When prices are high, your fixed amount buys fewer shares. When prices crash, it buys more, and your emotions are never consulted at any point in the process. Automation is how you protect the plan from the person most likely to sabotage it, who, and I say this with love, is you. The greatest investors of our generation aren't geniuses. They're people whose transfers cleared on the 1st and the 15th, regardless of what the news said. Then once a year, pick your birthday, pick New Year's, whatever, you spend 20 minutes rebalancing. If your target was 60/30/10 and a hot year turned it into 70/22/8, you nudge it back, which quietly forces you to sell what got expensive and buy what got cheap. That's the entire maintenance schedule. 20 minutes annually. People spend more time managing their fantasy football team, and that's genuinely the whole machine, which means we've reached the part of the video where I have to protect you, because the moment you start doing this right, an entire industry of people will materialize to help you do it wrong. Theory's great, but let me make this concrete, because I think watching the whole system run start to finish for one realish person is worth more than another 10 statistics. Meet someone we'll call Sarah. She's 27, makes $62,000 a year at a job with a 401k that matches 100% of the first 4%. She has $3,800 on a credit card at 24%, about $1,200 in checking, a 2014 Honda she refuses to apologize for, and until this morning, the financial strategy of don't look. Month 1, Sarah does exactly 3 things. She sets her 401k contribution to 4%, which is about $207 a month from her paycheck, and her employer immediately matches it with another $207. That match alone is $2,480 a year of free money she was previously donating back to her company out of politeness. Second, she opens a high-yield savings account paying 4.4% and moves her $1,200 into it as a starter buffer. Third, every other spare dollar is she finds about $450 a month after some honest budget surgery goes at the credit card. By month 9, the card is dead, and here's what that actually accomplished. Killing a 24% debt was the single highest returning investment available to her on planet Earth. Better than Nvidia, better than Bitcoin's best year, guaranteed. Months 9 through 18, that same $450 a month builds her emergency fund to about $7,000. Call it 4 months of her essential expenses, earning 4.4% while it sits there doing its real job, which is making her unfireable from her own financial plan. And then, around month 18, the fun part starts. Sarah opens a Roth IRA at Fidelity in 11 minutes on her phone, sets an automatic $450 monthly investment into a target date 2065 index fund at 0.12% a year, and closes the app. That's $5,400 a year into the Roth. Not quite the $7,500 max, and that's fine, because the max is a ceiling, not a pass-fail grade. Now, run her tape forward at a humble 7%. Brace yourself. If she never gets a single raise, never increases a single contribution, which is frankly insulting to Sarah, she is clearly going places. Her 401k with Match Plus, her Roth puts her around $1.1 million by 65. With normal raises and the contribution bumps her automated habit makes painless, she clears that number in her 50s. Total time invested in managing this empire, roughly 20 minutes a year plus the 11 minutes it took to set up. 18 months ago, this woman had a credit card balance and anxiety. The plan didn't require her to become a different person. It required 3 decisions and a direct deposit form. That's the whole trick. And it's exactly because the trick is this simple that an entire industry exists to convince you it isn't. Which brings me to the part of this video where I save you more money than everything we've covered so far combined. Here's the thing about the financial industry that nobody says plainly. Most of it earns money based on what you do, not on how you do. Activity, products, and complexity pay their bills. Your returns do not. Keep that lens on, and the following 4 traps become almost funny. Trap 1. The 1% financial advisor. Plenty of advisors are lovely people who will meet you at a nice office and manage your portfolio for just 1% of your assets per year. We already did this math with fund fees, and it's the same horror movie. 1% annually over an investing lifetime consumes roughly a quarter of your final wealth. Easily hundreds of thousands of dollars in exchange for typically putting you in the same index funds you can buy yourself in 11 minutes. And the fee scales with your money, not their effort. Managing a $2 million portfolio is not 10 times harder than managing $200,000, but it pays 10 times more. If you ever genuinely need help, complex taxes, a business sale, an inheritance, hire a fee-only fiduciary who charges a flat or hourly rate the way you'd hire a lawyer. Pay for advice. Never pay a percentage of your net worth forever for a service that gets cheaper to deliver every year. Trap 2. Whole life insurance pitched as an investment. At some point, usually right after your first decent salary, with the precision timing of a heat-seeking missile, someone from your extended network will reappear in your life to tell you about a policy that's life insurance and an investment. It is a worse version of both. The fees are enormous, the commissions are spectacular, which is why they found you and not the other way around. And the returns reliably lose to the boring 3-fund portfolio. If people depend on your income, buy cheap term life insurance, invest the difference in your index funds, and let your friend find a new career organically. Trap 3. Robo-advisors, Betterment, Wealthfront. These charge about 0.25% a year to automatically do what a 0.08% target date fund does. They're not evil. 0.25% won't ruin you. And if the app's polish is genuinely the difference between you investing and not investing, fine, it's a defensible training wheels tax. But understand what you're buying. A nicer interface on top of the same index funds at 3 times the price of the one fund solution. You now know enough to not need it. Trap 4. Crypto. And let's handle this honestly rather than smugly, because 2026 has provided the perfect case study. Bitcoin hit an all-time high around $126,000 in October 2025. As I record this, it's trading around $67,000 to $71,000, down nearly half in 8 months, with billions flowing out of the Bitcoin ETFs and record streaks. Now, plenty of people who bought years ago are still way up, and I'm not here to tell you Bitcoin is going to zero because I don't know, and neither does anyone on the internet yelling about it in either direction. Here's what I'd actually do. Nothing until the entire foundation we built today is finished. Debt gone, emergency fund full, match captured, Roth funded. After that, if you still want exposure, cap it at something like 1 to 5% of your portfolio and mentally classify it as speculation, not investing. An asset that can lose half its value while you're deciding what to order for lunch is not where the rent money or the retirement plan lives, it's the casino annex, and the casino annex gets casino money. Notice the pattern across all four. Every trap sells you a story about doing better, and every one of them mathematically guarantees you do worse. The boring plan has no salesperson because nobody earns a commission when you buy VTI and go take a nap. That's precisely how you know it's the right plan. Okay, real talk for a minute, because I want to reset your expectations about what behind and ahead actually look like in this country. Social media has convinced an entire generation that everyone else has a six-figure portfolio and a Roth IRA they started at birth. So here are the actual numbers. The median American household earns about $83,700 a year. The median retirement savings among households that have any at all is $87,000 total across all ages. For people aged 55 to 64 staring directly down the barrel of retirement, the median is $185,000 against the roughly $1.5 million Americans say they'd need to retire comfortably, and about half of US households have no dedicated retirement savings whatsoever. Not a little. None. I'm not sharing this to celebrate anyone's struggle. Most of those people were failed by stagnant wages, by jobs without 401ks, by a system that made all of this needlessly confusing on purpose. Like, I'm sharing it because if you do nothing but the steps in this video, starting from literally zero, you will be ahead of the majority of this country within a couple of years. The bar you're comparing yourself to on Instagram is fictional. The real bar is on the floor. Now, for the question everyone actually came here with, Nick, what can I realistically expect from my numbers? Let's run them. Using a 7% average return, deliberately humble given everything we said about 2026 valuations, $300 a month for 40 years becomes roughly $720,000. $500 a month becomes about $1.2 million. $1,000 a month for just 30 years, call it a later start with a better income, lands around $1.1 million. And in every single one of those scenarios, the majority of the final number isn't money you contributed, it's growth. The market did most of the lifting. Your only job was showing up every month and refusing to flinch. But here's the insight inside those numbers that almost everyone gets backwards. In your first decade, your investment returns barely matter. Seriously. If you have $10,000 invested, the difference between a great year and a mediocre year is a few $100, less than one decent overtime shift or one canceled subscription bundle. What matters early is your savings rate, how much you shovel in. A beginner obsessing over picking funds with an extra 0.5% of return while saving $200 a month is detailing the paint on a car with no engine. Crank the contributions first. The returns only become the main character once the portfolio is big, cries, and by then your habits are already built. This is also why I only have $50 a month is not a disqualification. $50 a month at 7% over 40 years is still about $120,000. But more importantly, the person who automates $50 today is the person who automates $500 when the raise comes. You're not building a balance yet. You're building the reflex. One last thing before I let you go, and in some ways, it's the most important section in this entire 50 minutes, because everything we've built today will, at some point, be stress tested. At some point, maybe next year, maybe in 5, you will open your app and see your portfolio down 30%. Given where valuations sit in 2026, possibly more. This is not a risk. It's a scheduled event with an unknown date. Historically, the market drops 10% about every other year, drops 20+% every several years, and has done so through every decade that ended with people wealthier than they started. The crash is not the system breaking. The crash is the system. It's the entry fee. It is the entire reason Stocks pay 10% while savings accounts pay 4%. So here's the protocol, and I want you to actually decide this now while you're calm, because you will not be capable of deciding it then. When the crash comes, you change nothing. The automatic transfer keeps running. Every paycheck now buys shares at a discount you'll brag about in a decade. You do not check the app daily. The red numbers are only real if you sell them. You do not watch people on the internet explain why this time is different. They said that in 2008, in 2020, in 2022, and every time different eventually looked exactly the same. New highs and a lot of regretful sellers. And you remember the one statistic from the beginning of this video: the best days in the market live next door to the worst ones. The people who get destroyed in crashes are almost never the ones who held. They're the ones who left and missed the recovery. Write it down somewhere if you have to. When it crashes, I do nothing, on purpose. Future you, at 2 a.m. scrolling headlines with sweaty hands, needs that note from present you. It will be the highest paid sentence you ever write. So that's it. That's the entire playbook I run if I were starting from my first dollar in 2026. Match, debt, emergency fund, HSA, Roth, index funds, automate, ignore. No genius required, no perfect timing, no password to some secret room. Just a sequence of boring decisions compounding quietly while everyone around you chases whatever's loud this quarter. And look, I get why this is hard to trust. We started this video in the second most expensive market in 140 years, with forecasters predicting a mediocre decade and 7 companies holding up a third of the index. Starting now feels reckless, but that's the final reframe I'll leave you with. The people who got wealthy from the stock market didn't start in safe years. There were no safe years. There was 2012's overvalued by 50%. There was 2020's pandemic. There was every single year, each with its own perfectly reasonable excuse to wait. The market has spent a century transferring money from the people who waited for certainty to the people who acted without it. You're not going to outsmart this market, and after today, you finally don't need to. You just need to outsit everybody who tries. Quick reminder, I'm not a financial advisor, and this isn't financial advice. It's education, and your decisions are your own. If this video saved you from a 1% advisor, an emotional sell, or a life insurance pitch at a family barbecue, share it with one person who's been meaning to start investing since 2019. Hit subscribe if you want more honest math about money, and I'll see you in the next one.